In the last part, we discussed the different kinds of healthcare settings, health services settings that provide health services, and the applications that we will discuss for healthcare finance in this course will include the following settings: hospital care, ambulatory care, long term care, and the integrated delivery systems. So, there is different types of legal forms of business. There is the proprietorship, also known as the sole proprietorship, in which the owner simply begins business operations and they don't open a company, they don't start a company, and they don't register one. They just, so the owner and the business are one and the same, and they pay taxes from their own. In a partnership, there is two or more people that associate and form a business. And then there is this corporation, in which is a legal entity which is separate and distinct from owners and managers. Now, there is some hybrid forms, for example, the limited liability partnership and the limited liability corporation. The limited liability corporation, for example, is an extension of the proprietorship where the owner and the business are no longer the same and they become two separate entities. So the owner actually goes and registers their business as a LLC, and even if it is only one person LLC, single member LLC, it is two different ownerships. So if something happens to the business, the owner will not fall in trouble. Now there is the advantages and disadvantages of proprietorships and partnerships. The advantages are there: it's easy to form, it is subject to few regulations, and there is no corporate income taxes. But the problem with these proprietorships and partnerships is that they have limited life. It is very difficult to transfer ownership. There is unlimited liability, and it is very difficult to raise capital for partnerships and proprietorships. However, in corporations, there is some advantages and disadvantages too. The advantages are there is unlimited life. So if you see the disadvantages of proprietorships and partnerships, which was limited life, has actually become an advantage in case of corporation. It is easy to transfer ownership, there is limited liability, and you can easily raise capital. You can get a loan and you can raise capital. The disadvantages are that the cost of formation and reporting is high, and there is, first of all, the cost of formation reporting exists, and therefore it becomes high because you have to pay the fees to the state and to the federal entities for forming your business. There might be double or triple taxation for investor owned operations. Now, in terms of forms of ownership, in most industries, the only form of ownership is the investor owned for profit business. In healthcare, only, I will not say only, but education is also one. But in the healthcare industry, there is a significant proportion of businesses, especially hospitals, that are organized as not for profit corporations. So, how much does ownership practice the influence of healthcare is a question that you should think about, and also influence the practice of healthcare finance. Is if you are a not for profit corporation, then you need to have a board of trustees, managers, employees, physicians, staff, creditors, supplies, and patients. And your goal is also a mission statement, whereas if you're investor owned, then you provide return to shareholders. In the not for profit, you don't have to provide return to shareholders. Um, Investor owned can get small amounts of grants, but the not for profit organizations can get bigger grants because they are tax exempt. And investor owned has to offer new services and technologies. They have this kind of pressure to do that, but not for profit, not so much. So there is this practice of healthcare finance, that gets affected with the practice of healthcare finance, with the change in ownership or with the difference in ownership. So, with investor owned corporations, investors become owners by purchasing shares of common stock. Stockholders have the right of control, and they can claim on residual earnings and residual liquidation proceeds. They typically expect a return on their investment in the form of dividends and or capital gains. Investor owned corporations must pay property taxes. they must pay income taxes, and they definitely must pay sales taxes. They also have to not just pay sales taxes, but they have to collect sales taxes from the customer. So if they are, for example, selling glasses or selling medicines, and those are products, so wherever, depending on wherever you live, for example, if you live in California, in a certain part of California, then you might be paying 10.25% of the taxes as sales taxes, 10.25% of the cost of the product as sales taxes on top of what you are paying for the cost of product. So the organization not only do they have to pay sales taxes, but the only way they can do it is by collecting it. If a business meets a stringent set of requirements, they have to meet a very stringent set of requirements. It's not easy. They can qualify as not-for-profit corporation. Such firms also are called tax exempt or 501c3 or C4 corporations. These corporations, they generally have no shareholders. They are exempt from property, income, and sales taxes. The primary goal of investor-owned corporations is shareholder wealth or stock price maximization. So a small business has owners that are managers and they work at your own schedule. Um, in the publicly held corporations, their shareholder wealth can be maximized, and the managers have and they look after their own welfare, employee welfare, and the good of the community. So, do investor owned businesses have any responsibilities to society at large? That's a question you need to think about. Is stock price maximization good or bad for the society? Should such firms behave ethically? So, investor owned businesses, as you can imagine, they have responsibilities for the society at large, even if they are tax exempt. They have to do good to the community. After all, they are providing healthcare services. So, stock price maximization is not always bad for society, as I would think, and probably you would agree. That is because when stock price is maximized, there is more return to the shareholders, and that adds to the financial health of the organization of the investor-owned hospital. And should such firms behave ethically? Absolutely yes, they should behave ethically no matter what. The primary goal of not for profit corporations is given by a mission statement, which is in the terms of service to the community. All businesses have stakeholders. Even if they are not shareholders, they have stakeholders. So, stakeholders have an interest in the business, usually financial interest in the business. They want the returns. Not for profit managers must satisfy all stakeholders. And for-profit managers are concerned with satisfying stakeholders. Their primary job is to satisfy the stakeholders. So, not for profit businesses generally are exempt from local property taxes and state and federal sales and income taxes. Overall, this benefit is worth several $billion annually to not for profit hospitals. Do not for profit hospitals provide community care equal to the value of their tax exemptions? Now, that is a very hard thing to say because if, let's say, you are providing vaccinations in the community, free vaccinations, you have to add the cost of vaccinations, you have to add the cost of labor, you have to add the cost of so many different things, some of which may not even be addable. And then you claim tax exemptions, so you have to equate that. It's kind of a hard calculation to make, but they are probably supposed to provide equal or equitable amount of community work as they are getting tax exempt. And should these hospitals be required to provide charity services equal to the tax benefits received? Um, that is also a question that you have to think about and is probably up for debate. If it is very hard to like, let's say you're giving food to people, and if you're feeding the homeless, you're feeding the people on the street, or you are collecting blankets and giving them. Not all of this can be, or you're collecting volunteers in the community. You're not even paying the volunteers. People are just coming and trying to help and collect blankets for the winter season. Not all of this can be quantified in terms of dollar value. And if it cannot be, then how do you know whether it can be equated to the tax benefits that were received by this not for profit hospital, right? So there is a little bit of muddy waters there. Now, you also need to think about the impact of health reform. Affordable Care Act had a significant effect on provider organizations that include accountable care organizations, industry consolidation, emphasis on population health, clinical integration or clinical excellence, requirement for more data analytics, staffing shortages in selected areas. Over time, the implications may have changed, but providers must respond to the changing environment to ensure future success. Now, the organization of this course basically we'll be talking about the healthcare environment, the basic concepts, insurance and reimbursement methodologies. Then we'll talk about financial accounting, where we talk about the basics, the income statement, statement of changes in equity, balance sheet, statement of cash flows. Managerial accounting, we talk about the basics, organizational costing and profit analysis, department costing and cost allocation, service line costing and pricing, financial planning and budgeting. The basic financial analysis concept, which we will talk about, is time value analysis and financial risk and return. Now, some of these concepts may be covered in the part two of this course, but we will still just go over all of the topics that are in the book. So those are the topics that are all covered in the book. But this book has two parts in which the course is taught here. So the first part I'm teaching this semester, and the second part is going to be taught in the fall, which will be more advanced. So chapters 1 through 8 are covered in this course semester, and then which is the healthcare finance basics and accounting, and then the second course, which will be taught in the fall, will have more advanced concepts. So long-term financing shows long-term debt capital, equity or ownership capital, capital structure decisions, and the cost of capital. Capital investment decisions include cash flow estimation, break-even and profitability measures, risk assessment, and risk incorporation. There are some other topics, and not all may be covered. So revenue cycle management, current account management, break-even analysis, cost allocation, current asset financing, and analyzing for financial performance, on which I also have a paper that you are supposed to read as part of the assignment, the purposeful reflective reading assignment, lease financing, business valuation, and profit distribution to owners. So this concludes the discussion of chapter 1, and thank you very much.